Hello friends, welcome to the channel JAIIB and CAIIB Made Simple. In this particular video, we are covering unit number 9 theory portion of ABFM and the chapter name is Capital Investment Decision. So before delving into the chapter, let's see what are the topic which we have to go through. Objective, introduction, we have to see objectives of capital investment decision, estimation of project cash flow and social cost benefit analysis, which is called CBA. Right, so this is a very interesting chapter. We will apply the concept which we have learned in the previous two chapters. So let's get started. Ever wondered? So first of all, let's talk about this so-called capital investment decision. So I hope you are able to clearly view the slides which I am presenting before you. Now, have you ever wondered why some business thrive while others slowly fade away? Is it just luck, or is there any secret behind long-term success? So in this particular lecture, we are diving into one of the most critical decisions that financial manager and entrepreneur make, and this decision is what we call capital investment decision. This is called capital investment decision, right? So if you are preparing for ABFM, this is a must-know topic that will not only help you crack the exam, but also give you a real-world perspective on business growth. So let's start with the foundation. This is called foundation of the growth, capital investment decision. When someone starts a business, it is not just about having money or a high risk appetite. A successful venture requires strong team conviction and a well-planned scientific approach to decision making. Right? So think of it this like this. That is what is written here. Think of it like this. If you are planning a road trip, would you just jump in the car without a destination or without a map? No, right? Similarly, business need a solid investment strategy, right? So you must know that business need a solid investment strategy. This is what business need, right? Business need a solid investment strategy before they start spending money, right? So that is why it is called the foundation. Now the question is, why do capital investment decision matter? What is the objective of it? Why does it matter? Let's understand. What is the ultimate goal of this so-called capital investment decision? You know, the ultimate goal is simple. The ultimate goal is maximizing shareholder wealth. So let me highlight the point which is key point, that is maximizing the shareholder wealth. So this means making a smart financial move that increase the company value, right? To do this, financial manager must analyze the potential investment, must identify the growth opportunity and ensure that company does not run out of the valuable asset, right? So here is a case study which is provided before you. Let's understand this case study. So I think now it is clear why we need to have the capital investment decision. The reason is that the main goal is to maximize shareholder wealth, to analyze potential investment. Let's do one case study here. So friends, company A spend everything and reinvest nothing. So what the company A does, it spend everything, right? It spend everything and reinvest nothing, right? Reinvestment is nothing, no reinvestment. What happened? The business run out of the resource and slowly decline. The result is gradual decline due to asset depletion. So this is about the company A. Now let's look at the situation of the company B. So what did company B do? So you can see company B only replace worn out asset but avoid new opportunity. Only replace worn out asset but avoid new opportunity. So what happened? The result, no real growth, right? In company B there was no real growth, just survival mode, right? Now let's look at the company C. Company C invests smartly in all profitable opportunity. So they invest in all profitable opportunity smartly, and what was the outcome? The outcome was their wealth was maximum and also long-term success, right? So what is the lesson from this three case study? Is that a smart investment is the key, right? Smart, if you keep your money idle without investing, it is no use, right? And if you only replace the deteriorating asset, so you are missing the valuable opportunity. So smart investment is the key, right, to the thriving business. So the next time you hear about capital investment decision, remember, it is not just about spending money, it is about making the money work for you. This is very, very important thing. So whenever you hear this word so-called capital investment decision, it means making money work for you, right? So stay tuned for more insight that will not only help you in CAIIB but also give you a sharper financial mindset. So now let's look at the key consideration that we have. So friends, imagine you are starting a business. You know you need money, but have you ever thought where will it come from, how much you will need, when you will need it, and most importantly, how will you manage it. If not, your business might sink before it even sets sail, obviously. So welcome back, future CIIB aspirant. So obviously today let's break down some key consideration in capital investment decision. Trust me, this is crucial, not just for your exam but for understanding how real business survive and grow. So let's discuss the key consideration in capital investment decision. Before investing in a project, business need to assess 5 critical factors. What are the 5 critical factors? The first is a requirement, means how much money do we actually need. How much money, right? That's next is the source, where is the money coming from, right? Is it loan, is it from, just let me write down, is it from loan? The sources is either the loan, or is it the investor, or is it the saving? So what is the source of it? Cost means how expensive is this funding, right? Is the funding expensive enough? Is the funding expensive? So this is what they have to answer. And the form is what is the investment, form is the investment in cash, machinery, property, or technology, means the investment we are doing in which form. And finally we have time schedule, means what, when do we need the money, right? When do we need the money, when money is needed. So that is called time schedule, all at once or in stages. So these are the 5 critical factors that you must ask, right, before investing a project. So requirement means what, how much money do we need. Sources means what, where is the money coming from. Cost means what, how expensive is this funding, are we paying higher interest. Form means what, is the investment is in cash, machinery, property, or technology. And time schedule means what, when do we need the money. Think of this like planning a wedding. You can't just set a date without considering the budget, venue, and timing of expenses. So the same logic apply to the business investment. You have to look at the requirement, right? When do we need the money, what are the sources of it, how much cost we will pay for that money, what are the forms, right? And what are the time schedules. I hope this makes the sense. Now let's see, estimation of project cash flow. Here it is. Now let's talk about cash flow. Cash flow, cash flow is called the life, this is called lifeblood. This is called lifeblood of any business. So when business plan investment, they need to analyze few things. What they need to analyze? The first thing they need to look at long-term and short-term needs. They need to examine the long-term and short-term needs, first thing. The second thing, they need to look at the earned and borrowed fund. The third thing, they look at the fixed cost. Fixed cost means like rent and salary. And the fourth thing, they need to look at the working capital, which means for daily operation. So whenever business plan investment, they need to analyze all these four things: long terms and short term needs, earned and borrowed fund, fixed cost, and working capital. So this information help in creating a projected cash flow statement. On the basis of this data, we can prepare a projected cash flow statement: long term and short term needs, earned and borrowed fund, fixed cost, working capital. So we can help us to prepare a projected cash flow statement. And what is this projected cash flow statement? This is like a roadmap. This is like a roadmap for financial stability. Now let's discuss the element of cash flow. Right, so let's discuss in clear way the elements of cash flow. The first element is the initial cash flow. What is the meaning of initial cash flow? See, money is spent before the project even start. Right, project has not started yet, but the money is spent in that is called initial cash flow. This includes, like what it includes, suppose we buy machinery, which is included in the initial cash flow. Suppose we set up the office, it is included in initial cash flow. Suppose we arrange fund for daily operation, it is included in initial cash flow. Means all those money spent before the project even start, right, is called initial cash flow, like buying machinery, office setup, and arranging fund for daily operation. This is called initial cash flow. The second element is called operating cash flow, means money going in and going out when the business run. So suppose this is our business, money is coming in, money is going out, right? So money going in and going out as business run, right? So what brings money into the system? Sales bring money, and what goes out? Expenses takes the money out, right? So this is called operating cash flow. And last we have terminal cash flow, which means the final cash flow left when the business wrap up. So wrapping up the business, whatever amount is left is called terminal cash flow, after clearing all debt and obligation, right? So we have the 3 cash flow: initial cash flow, operating cash flow, and terminal cash flow. Imagine you are starting a restaurant. You need money for furniture and equipment, right? So you need money for furniture and equipment, and that money is called initial cash flow. Also you have your daily expenses, you have your daily sales, you need money for that also, that is called operating cash flow. And if you ever sell the business, whatever cash remain after paying debt, that is called terminal cash flow. Remember, whatever amount left after paying debt is called terminal, right? I hope this makes sense. Now the golden rule, let's discuss the golden rule for estimating cash flow. So there is a principle for estimation, right? So what is the golden rule? The first principle is called separation principle. What it says, let's understand. It says that keep investment cost separate from financing cost. Two things are there, investment cost and financing cost. Keep them separate. Now you may wonder, what is this investment cost, what is this financing cost? Let's answer this question. So whenever I say investment cost, it simply means, just wait a minute. Yeah, whenever I say investment cost, it simply means the money spent on project, right? So investment cost means whatever, how much money you have invested on project, money invested on project is called investment cost. And whenever I say financing cost, what it means money borrowed to fund it, right? Money borrowed to fund it, right? So two things are there. Separation principle says that we have to always keep investment cost separate from funding cost, separate from financial cost. Investment cost means money, how much money you have spent on the project, right? How much money you have spent on the project is called investment cost. Let me write it down. Spent on project, how much money you have spent on project is called investment cost. And financing cost means money borrowed to fund it, how much money you have borrowed from bank or somewhere else, right? That's the difference. Then there is another principle which we call an incremental principle. It identifies which costs are fixed, right? Tell me some fixed costs. Let me provide you the name of some fixed costs, like you might have heard of rent, salaries, right? So these are the kind of fixed cost, right? So incremental principle separate fixed cost and variable cost. So rent, salaries are like fixed cost, and variable cost, like it can be electricity, raw material, it can be variable cost. Then we have post-tax cash flow, which means always look at the profit after tax to know the real return. Yes, very very important. So what is happening, that you have paid the taxes you have paid, and after paying the tax, whatever profit is left, so that is you should look at that profit, right, to see the real return. And the last principle is called consistency principle, which means maintain a uniform method when calculating all cash flow, no shortcuts, right? So just like maintaining a diet plan, you separate gym expense from food cost, you track fixed calorie and ensure consistency in your meal plan. Miss one step and the results suffer. So that is what these four principles are super important. First principle say investment cost and financing cost should be separated. Incremental principle say fixed and variable cost should be differentiated. You should calculate return after paying all the tax. And consistency principle say you should maintain consistency in treatment of all cash flow component. We know there are three components, so there should be consistency in treatment of all cash flow component. So the next time someone talks about investment planning, you know it is not just about having money, it is about managing it smartly, right? So I hope this makes sense. If you think that this video is valuable for you, you are able to clear your concept, please hit the like button, because this will motivate me to make more such and such content. Now let's discuss our next part, that is collating cash flow component. We know there are three cash flow component, right? So imagine you are running a business, you have got money coming in from sales, but at the same time you are spending on raw material, salaries, rent, loan repayment. How do you make sure your cash does not dry up before you even break even? That is where cash flow management comes into picture, and that is what we are going to discuss now, right? So again I am repeating, imagine you have a business, right, and you got money coming in from sales. So your product is being sold, you got your money coming in, but at the same time you are spending on raw materials, salaries, rent, loan repayment. But how do you make sure your cash does not dry up before you even break even? How will you know? So this is where cash flow management comes into picture. So let's break down essential topic, that is collating cash flow component and forecasting capital in the simplest way possible. So first of all, let's talk about this so-called collating. So friends, you need to track every rupee that goes in and goes out. Business do this by categorizing their cash flow component. They categorize their cash flow component into what? You see, they categorize into fixed capital. Fixed capital means money spent on things that last long, like building, like machinery, like computers. Working capital means money needed for daily expense, like raw material, salaries, bills. equities and long term borrowing. What it means? It means money raised from investors or bank to fund major investment. So investors money or bank money. And lastly, operational outflow. Operational outflow means cash spent on production. There are some operational outflow: cash spent on production, administration, or marketing, or loan interest. So these are called operating outflow. And finally, we have sales and service outflow. It means revenue coming in from selling product and services. So basically, the goal is to ensure that business had enough cash to survive and grow while covering key objectives like breaking even and repaying debt. Right. So think of it like planning a vacation. You need to budget for flight. You need to try to budget for flight, hotels, foods, and shopping while ensuring you don't run out of money before the trip ends. So this is all how business can acquire the cash flow. We have talked about the business categorize the cash flow into different part, and they look at the every part. They ensure that every part is fulfilled. Now let's discuss forecasting and regulation of capital. So friends, what does it mean? So a business does not just look at today's expense. It plans for short, medium, and long term. Right, here is how it does. So first of all, let's talk about the long term capital need. So it means big investment. It includes something called big investment. Right. So this includes buying land, buying factory, buying office premises, installing machine and tools, office setup like furniture, office equipment, computer. Right. So these are one time investment. You must know that this long term capital investment, this is a one time investment, right, but requires long term funding like loan or equity. Think of it like buying a house. You don't pay for it all at once. You take a loan and repay it over the time. So that is called working capital requirement, right? And then we have something called, that is called long term requirement. Now let's talk about working capital requirement. To run a business smoothly, you need money for buying raw material, work in progress, paying salary, managing stock, handling daily expense. So your working capital cycle determines, so here is the key point, this is called working capital cycle. It determines that how long you can keep the business running before earning back your money. Just like running a household, you need cash every month for grocery, rent, electricity, and a school fee. If you don't plan well, you may end up borrowing, right? So this is called duration of working capital cycle needs to be tied to the business operating cycle, right? Now question is, where does the money come from? What are the funding sources? So let's discuss here. So business raise fund in two main way. The one way is the long term fund. The first way of bringing fund is the long term source, right? This comes from, either it can come from equity. So whenever I say equity, it means investor. It can either come from equity, which means investor, or bank term loan, which means bank funding, which is called term financing. So there are main two way of raising capital. One is the equity, another is the term financing. So what is the meaning of equity? So whenever you see this word equity, it means investors money, and whenever you see term financing, it means bank money. So these are the two methods of raising fund, right? So running a business is not about making money. It is about managing money smartly. Tracking cash flow, forecasting needs, and choosing the right funding source are what make business financially strong, right? So I hope you got the key parameter which we need to consider while having capital investment decision, right? Now let's talk about working capital and regulatory consideration. So have you ever wondered how business manage their daily expense without running out of cash? Just like we plan our monthly budget at home, business must carefully manage their working capital to stay afloat and grow. So friends, welcome to this particular session, and we are talking about working capital and regulatory consideration. So first of all, before starting this discussion, let us first understand what is the meaning of this so-called working capital. I think you know the meaning of it, right? So it is the money business use for day-to-day operation, right? So you must remember this keyword. The keyword is day-to-day operation, right? The money which is needed for day-to-day operation is what we call as working capital, right? So like paying supplier, salary, covering short-term expense. So the question is, what are the funding source? Where does this money come from? So it can either come from company's own fund, right? It can be either come from company's own fund, and part of it can come from supplier or sundry creditor. What is the meaning of this sundry creditor? Yes, business often buy goods on credit and pay later. Means that suppose you have a business and you buy some goods on credit. उधार पे आपने किसी goods को ले लिया, बाद में आप उसे payment करेंगे, right? So this is how working capital comes, and it also come from payables. Payables means what? It's that you borrowed from bank. You borrow money from the bank, right? So some of it come from company's own fund. Company has fund also, right? So it comes from own fund, it comes from payables, and it comes from sundry creditor. So think of it like running a shop, right? So you buy goods from wholesaler on credit and pay them after selling to customer. This keep cash flowing. Now there are some rules and regulation for raising finance. Let's discuss it. So business can't raise money in any way they like. There are rules to follow, and the rules are governed by the Companies Act 2013. So this law govern how business raise fund through equity share, which means ownership given to the investor, preference share, which means investor get a fixed return but no voting right. We have covered it in the previous lecture. And debenture. Debenture is just like a loan from an investor that the company must repay. Think of equity as owning a piece of the company, preference share as earning interest without control, and debenture as a lending money to the company for a fixed return. So there are rules which are governed and which are covered in the Companies Act 2013. Now let's talk about this debt equity ratio, which we call DER. Right, DER rating norms, and rating norms, two things we are discussing. What is debt equity ratio? So this is the balance between borrowed money and the owned money. So that is called loans and equity. So the balance between loan and equity is what we call as DER, right? So too much debt can make a business risky. And also second point which we are talking about is the credit rating. You know what is credit rating? Let's discuss it. So credit rating means what? Before giving loan, bank check a company's financial health through credit rating. A good rating means lower interest rate, while a poor rating means borrowing is expensive. So it is like applying for a personal loan. If you have a good credit score, bank trusts you and offer lower interest rate. But if your credit score is bad, you pay more. Now let's discuss the relationship between sales, production and functional budget. Very very important point. Let's cover it. You know, a business cannot survive without planning its money wisely. So planning is very very important. So planning money wisely is very very important, right? So it must estimate how much cash it needs. A business must estimate how much cash is needed for operation, right? So first of all, estimation is quite important. Forecasting should help. So bank consider how much fund required for operation, right? So then how much money will come from sales and service, right? What are the fund from sales and service? So and also how different department like account, finance, marketing, HR, IT, right, will contribute. So these things bank business must estimate. So think of it like planning a wedding. You budget for food, decoration, venue, music, while ensuring guests bring enough gift to cover the cost, right? So that is how it is all about. Now let's talk about this so-called cash forecast. Very very important. A business must forecast, that means predict. Whenever I say forecast, it means predict. So a business must predict how much cash will come in and go out based on the factors like, what are the factors? Let's see. The first factor we have is the sales estimate. What it means? That how much will the business sell. Then we have production capacity, which means can the company produce enough. You can see sales production capacity, can the company produce enough. Then we have raw material availability. What is the meaning of raw material availability? It means can supplier deliver on time. Then we have product pricing, which means will customer buy at set price. Then we have competition, which means obviously it means the same, that will customer buy at the same time. And finally we have market condition. Is demand rising or falling? It's like planning your salary usage, predicting expense for rent, grocery and bill, while ensuring you don't overspend. So managing working capital is all about balancing income and expense, right? So you are balancing your income, you are balancing your expense, following regulation, forecasting future cash flow need. So business that plan well grow steadily, while those that don't may struggle. So that's planning is very very important. Now let's look at this so-called CFAT, right? Very very important discussion we are going to do now. So friends, imagine you are running a business and you just bought a new machine. How do you calculate if it is really profitable after tax or not? So suppose you bought a new machine. How will you calculate? How will you judge that whether it is really profitable after tax? That is where CFAT comes into picture, which we call cash inflow after the tax. So here, friends, CFAT stands for cash flow after tax. Let's understand it in a super simple way. CFAT is actually means the actual cash a business get to keep paying all cost and taxes. That is called CFAT. So I will explain this particular table. Just wait a minute. So for the time being, let me explain what is CFAT. CFAT means actual cash that the business will get to keep after paying all cost and tax. So suppose Suppose this is a business, it has paid all cost, it has paid all taxes. So whatever amount is left, right, whatever is left, the actual cash which the business get after paying it tax, after paying all cost, is called CFAT. It helps business decide if an investment is financially beneficial or not, right? So this CFAT helps to decide business. Now unlike profit, CFAT includes depreciation, right? So one thing you must know, that depreciation is a part of this CFAT to show the real cash available. So you can think of this CFAT as your monthly salary. You get paid, but after deduction like tax, PF, etc. So the real cash in your pocket is what matter, and that is what CFAT is all about. I've given you the best example of it. Now let's break down. Let's consider the type, what are the typical component of the CFAT, how to go about calculating this CFAT step by step. Let's say companies sell products, right, and earn revenue, which we call sales value. This is the value which the company earn after selling the product. So first of all, what we will do, so this is our sales. I again present before you this picture which I have already shown you. So this is our sales, this is our variable cost, we subtract it, what is left? So variable cost includes like let me give you some example, like raw material, like wages, like electricity bill, which is variable. So we subtract all these components from sale, we get something called our contribution per unit, contribution, right? And in this we have fixed cost, you know it variable. Fixed cost include so we get contribution, you know it variable, and if you from contribution, if you subtract fixed cost like rent, which is fixed, like insurance, which is fixed, like salary, which is fixed for a company, if we subtract this fixed cost, right? So and also here one more thing which you keep in mind is depreciation. So depreciation component also comes into the picture here. You need to subtract depreciation. Why? Because although it is not actually cash spent, it reduces taxable income. Depreciation, it reduces your taxable income. You know it very well that your tax get reduced because of it, so you have to subtract that. So after doing that, you will get something called EBT, earning before tax, EBIT we call it, or EBT. So this is your EBT component, right? So EBT. Now what you will do, you know earning before tax you have calculated. So from EBT, just wait a minute, let me erase it. So this particular pie chart is super useful to understand the CFAT, right? So after subtracting EBT, no sorry, after you will get EBT, right? EBT is earning before tax, and now earning before tax from EBT, if you want to go to EAT, that is earning after tax, what you will do, you will subtract the tax component, right? So that is what you do. So you deduct the tax to get EAT, and what you will do, you will further add this depreciation to get CFAT, right? So this is how you will calculate the CFAT. You imagine you are running a food truck, you buy ingredient, that is variable cost, you pay for licenses and rent, that is fixed cost, and use a grill that wears out over the time for your food truck, that is depreciation. So CFAT tells you how much cash you actually have at the end, right? How much cash you actually have at the end. So this is the step-by-step process to calculate CFAT. Let me illustrate it using an example. So let's discuss. XYZ is buying a new machine, right, worth rupees 1 lakh, right? Worth rupees 1 lakh machine he is buying, that lasts 4 years. So it will last for 4 years. They use a straight line depreciation method. So the machine loses how much value per year? 25,000 value per year. Let's look at the expected earning before depreciation and tax. So we are interested to look at the expected earning before depreciation and tax. So let's discuss. Economic life is 4 years, you know. Yearly, you can see yearly profit distribution here. Yearly profit after depreciation. 2021, 45,000. Right. So how it comes to 45,000? Let's discuss it. So basically what is happening here, that depreciable base is 1 lakh, economic value is 4 year, right? So earning before tax and depreciation in 2021 is 45,000, 2022 is 30,000, right? 2023 is 25,000, and 2024 is 35,000. So think of this depreciation like a mobile phone. You buy it for 40,000, but in 4 years it loses value and is worth almost nothing. Now let's calculate the let's compute the cash. So let's compute the net cash flow for XYZ Limited. So first of all, what you will do, you will subtract this depreciation, right? You will subtract this debt. So this is the cash flow, right? Whatever we have shown here, this is the cash flow. This 45,000, 30,000, 25,000, 30. Basically it is doing a business, right? it is doing a business. And what was the 1 lakh rupees? So 1 lakh, it buy a new machine worth rupees 1 lakh in the last 4 year, right? That will last 4 year. So it buy a new machine, right? That is fixed cost here, and this will last for 4 year, and this is the cash flow for 4 year. For first year 45,000, second year 30,000, and so earning, these are the earning before tax and depreciation, right? Earning before tax and depreciation is given to you, that is called EBT. EBT value is given, right? So for 4 years is given, tax rate is given 20%. So we will compute the relevant cash flow. So now you can now let's compute the net cash flow for XYZ. So for that we will break a table. So what we will do step by step. First of all, you will deduct the depreciation, right? You can see for we have made 4 column, 2021, 2022, 2024. So we have written the earning before tax and depreciation which were given to us. Now first of all, what we will do, I've told you that earning before tax and depreciation, first of all you will deduct depreciation, right? What is depreciation? 25,000 per year, because it is using a straight line depreciation method, right? So that is why the depreciation value will be same every year. So just subtract 25,000 from each EBT. So first you will get 20,000, then you will get 5,000, this will be 0, and this will be 10,000. So this is called earning before tax. Now you have earning before tax. Now you want to calculate EAT, that is earning after tax. So what it means that earning before paying the tax, your earning is 20,000, sorry 20,000, and what is the 20% of this? That is 4,000. So you pay 4,000 in tax. So after paying tax, your earning will be 16,000. Similarly here 5,000 is your earning. Calculate 20% of 5,000. This will be 1,000. You paid 1,000 in tax. So whatever amount left is earning after tax. It is 4,000. Similarly here you will get 8,000. So that is EAT. And I told you to calculate CFAT, we will further add the depreciation. So whatever depreciation we have subtracted, we have to add it back. That is what we have done in the last step, right? So add depreciation and we will get CFAT as this one, right? So I hope this is clear. So even though the company profit varies, the actual cash flow remains steady because depreciation is added back, right? So that is the point which we have learned from this particular course. Even though the company profit varies, right? Profit varies, but the actual cash flow remain steady, right? You see it is remain steady because the depreciation has been added back. So why CFAT is important? Because you know it helps in investment decision. Should the company buy this machine or not? So this CFAT answered the question that should this company buy this 1 lakh rupees machine or not. It shows real cash position, not just profit but actual money in hand, right? So I hope CFAT is the real money a business has after covering all expenses and tax. And understanding this will make you a smarter banker and investor. Now let's discuss the cost analysis for project. Very important. So friends, ever wondered what goes into setting up a new project? What are the costs involved before business start making money? So friends, let's discuss. Project cost analysis is the best way, simplest way possible. Let's understand it. So the first of all, what is the meaning of this so-called project cost? What is the meaning of this so-called project cost? You know, project cost means total money needed to start a business and make it operational. So what is the money you need to start a business? Right, the money you need to start a business and make it operational is called the project cost, right? It includes everything from buying land and machinery to setting up power supply and even legal paper, right? So let me show you this breakdown. Everything it includes, right? You buy the land, you set up the machinery, right? And also legal fee, stamp duty, you can see this is included under it. Fixed cost, these are the fixed cost, right? So think of it like shopping list for starting a business. Imagine you are opening a restaurant. You need to buy the land, right? You need to build the place, you need to install a kitchen and get licenses. All these expenses together form your project cost. So first of all, we have the fixed asset cost, like land, which is a tangible investment. So it includes all kinds of tangible investment like land. Buying versus renting affect cost. You know it very well, whether you should buy or you should rent. So it includes stamp duty, legal fee, leveling and preparation. Then we have factory building. The second component is factory building. What it means that cost depends on whether you build, buy or rent. Obviously cost varies, and it includes acquisition cost, it includes stamp duty, legal fee and construction expense. Then we have plant and machinery. This is also part of the fixed cost. So plant and machinery cover purchase price, custom duties, transportation, installation. Everything is included under plant and machinery. Then we have power supply setup. So cost of electricity line, transformer and internal wiring, as the name itself suggests, it is part of the fixed asset. Then we have environmental compliance. So includes expenses for pollution control, right? You take clearance from pollution control board, some expenses are there. You whatever pollution control measure you take. Then we have something called tree plantation and maintaining waste management. So these are the cost included. And think of the fixed asset as the permanent thing a business need to function, like setting up a home and furniture, kitchen appliance, electric connection, etc. Then we have, so these are the tangible assets which we have just covered now. Then we have some intangible asset. You can see intangible asset are the legal and intellectual expense required to run a business, like registration. So it means business licenses and approval, patents, and trademarks. It protects business ideas and brand name. Then we have invention and discoveries, which means cost involved in research and development, R&D, which we call it. And then we have data and software system, means digital tool required for operation. So these are called intangible asset. Why? Because think of intangible asset as in paperwork and brand value of the business, things you don't touch but are super important. Then we have why project cost analysis is important, because it helps business plan their finance before starting. It is essential for bankers, right, to evaluate loan request, and it ensures project have enough fund to cover all cost. So project cost include everything a business spend before you start earning, right. Now let's discuss the installation and setup cost, which is the next part of it. So friends, have you ever thought about what goes into setting up a factory or business unit? It is not just about buying machine. Installation and setup have their own cost and challenges. Let's discuss into. Think about setting up a home. You don't just buy furniture, you need to arrange it, install appliances, set up utilities. So business face the same situation. Installation cost varies across industries, right? It varies across industry. Simple units have minimal setup cost, so they have minimal installation expense. But some complex industries like refineries, pharmaceutical or chemical processing plant, they need high-tech installation, right. And you heavy engineering plant require cranes and movement facilities, right, so to install machine. So the bigger and more complex the business is, the higher the installation cost. Clear cut rule. Now the question is, why is installation is more than just cost, right? This is a very good question. Why is installation is more than just a cost? Because this is not just about money. Installation is not just about money, it is about planning. Planning means where will each machine go, how will material move. It is about logistic means transporting and placing massive equipment. It is about time and motion study, which means ensuring efficiency in setup. It's about manpower means worker dedicated to installation. So a poorly planned setup can increase cost and delay production. That is why business must manage installation like a well rehearsed performance, right. So this is all about the installation cost: planning, logistic management, time and motion study, etc., etc. Now there we have something called direct cost for business setup. Every rupee spent during installation should be recorded and accounted for. So whatever amount is spent during installation, it should be recorded. So some key financial practice include linking each expense to a specific asset, right. So linking each expense to a specific asset, right, or like machine, building, whatever expense is there, you should link to the specific asset. Properly classifying expenses under asset account. So these expenses should be classified under the respective asset account, and recording construction period expense separately for clarity, right. So construction period expense should be recorded separately, right. Think of it like this, like tracking every penny spent while building your dream house. Then we have something called other setup cost. So there are some other setup costs also included. So apart from installation, business also incur something called general administrative cost, right. So something called general administrative cost is incurred by business, like a staff salary, office expense, and also there are some operating costs are also incurred. So many of these costs can be capitalized, means added to the value of fixed asset, ensuring better financial management. So you see this word capitalize. What is the meaning of capitalization? Capitalization means this cost can be added to the value of fixed asset. That is what I mean when I say capitalize, right. So that is called capitalization. So I hope this makes the concept clear. Direct cost for business setup. Now cost analysis. It means cost analysis highlight. Just let's highlight, take the highlight. So it means making sure that every rupee count. So before spending big money on asset, business need to ask themselves some critical question. What are the question they need to ask? First of all, they need to ask that is this asset really needed? That means right type, right brand, etc. Right. So is this asset really needed? What is the necessity of this asset? They need to ask this. Then are we using the best production method? Means are we using the best combination? Did we get the best deal? That is called competitive bargaining. Did we get the best deal? That is negotiation. It saves money. And finally, are we recovering all tax benefit? Are we recovering all taxes benefit? ITC, input tax credit. And should we buy or should we lease? That is called leveraging. Should we buy or should we lease? These are the key questions which a business should ask. And also, does this asset have a long lifespan? So smart banker and business owner focus on these details before applying big investment, before approving big investment. Now, then we have justification and environmental impact. You know that business don't just spend money, they must justify every investment. Common mistake to avoid. What are the common mistake to avoid? The first mistake is that, let's talk about the mistakes to avoid. So the first mistake is that buying unnecessary or oversized machine. So here it is. So you know you are buying unnecessary oversized machine, no needed, no required that. Keeping idle asset that don't realize, that don't generate revenue. So business must also consider environmental impact, like what is the power consumption, what is the pollution, what is the effect on surrounding and sea life. So sustainable business don't just chase profit, they invest in eco-friendly asset for long-term success. So setting up a business is more than just buying machine. It is about a smart investment, financial tracking, and sustainability. So I hope this make your concept clear. This is called justification and environmental impact. Then we have something called growth consideration. So let's discuss this growth consideration. So friends, have you ever thought about how business plan for future growth while keeping cost in check? So in this slide we are diving into growth consideration and investment appraisal. So imagine setting up a business and realizing 2 years later that your machine can't handle growth demand. So you have set up a business and after 2 years you realize that your machine can't handle growth demand. This is what you realize. Your machine can't handle the growth demand. That is why cost analysis must be future proof. Right. So the cost analysis, it should be future proof. So what are the key growth factor to consider? The key growth factors to consider are includes like capital investment, capacity enhancement. Capacity enhancement means what? Planning for future expansion right from the start. Then it includes R&D, research and development, which means investing in innovation to stay ahead. And then we have something called technology upgrade, ensuring equipment does not become obsolete. So that is called growth considerations. Smart investment today prevent expensive upgrade tomorrow. Then we have sustainability. What is the meaning of sustainability? Sustainability simply means long-term stability. So a business is not just about making money, it is about surviving and thriving. So you know there are some important things: incorporating assets means buy durable efficient equipment. It's about manpower means hiring a skilled employee who adapt to growth. And then we have technology, which means investing in automation and digital tool, and R&D, which means staying ahead of competitor with monetization, with innovation. So sustainable project is not just profitable today, it will remain strong for years to come. Then we have something called projected returns. So you know, before investing in a project, business must ensure that they are making a profitable decision, right? So what do they analyze? They analyze something called expected profit, right? So what are the expected profit? Then they also see the risk level, right? So what is the risk level? What is the resources required? So a clear target is required. Then we have the something called investment appraisal. Very important point. How do business decide if an investment is worth it? So they use a special 4 financial tool, and let's discuss the 4 key method of investment appraisal. I will cover it in detail. The first is called NPV, net present value. You calculate the total value of future profit, help decide if the project is financially viable or not. This is called NPV. Second thing we have is called IRR. What is IRR? Internal rate of return. It means you find the interest rate at which NPV becomes 0. So the interest rate at which NPV is equal to 0 is called IRR. So higher IRR means a better investment. And we have something called payback period. What is the meaning of payback period? Payback period simply means how long will it take to recover the initial investment, right? So if the payback period is shorter, it means low risk, simple. So we can say that short payback period it means low risk. And finally we have profitability index. So it compared present value of profit with the initial investment, right? And you know this profitability index, if it is greater than 1, it means project is profitable. So you should know all these 4 parameter. NPV, again I am repeating, NPV means net present value, means today's value of the future profit. It helps in decide if the project is financially viable or not. If NPV is greater than 0, it is viable, less than 0, not viable. Then we have interest rate return, IRR. So IRR is finds the interest rate where NPV becomes 0. Higher IRR means better investment. Payback period, it means it measures how long will it take to recover the initial investment. Shorter payback period, it means lower risk. And finally we have profitability index, which means compare present value of profit with initial investment. And PI greater than 1, it means project is profitable. So these tools help business make a smarter investment decision, ensuring financial success. So I hope these methods are clear. We will cover in detail. Now let's discuss payback period and discounted payback period. Very, very important part. So friends, ever wondered how business check if their investment is paying off quickly? Let's talk about the payback period and discounted payback period. So imagine you invest rupees 10 lakh in a business. Let me give you an example. Suppose you invested 10 lakh in a business, right? And it earns rupees 2 lakh profit per year. So how long before you get your 10 lakh back? That is your payback period, right? So you invest 10 lakh in a business, right? And it earns rupees 2 lakh. It earns rupees 2 lakh per year as a profit. So how long before you get your rupees 10 lakh back? That is called payback period. And the formula is quite simple. Initial investment upon estimated annual net cash flow, right? So remember, if the profit are constant, just divide, right? So you must remember it. If the profit is constant, so what we need to do, we just divide. So and if the profit changes yearly, keep adding the cash flow until it's equal your investment. So two things are there. So if the profit depends on profit are constant or not. If profit is constant, right, just divide it. And suppose if the profit is not constant, you should keep adding the cash flow until it equal to your investment. So shorter payback, if payback is shorter, it means faster recovery, it means lower risk. So I hope this makes sense to you, right? You should know the formula of it. Depending on whether it is our profit is constant or not, the formula changes. And then we have something called discounted payback period, right? What is the meaning of discounted payback period? So adjusting for time value of money. But wait, money today is worth more than money tomorrow, right? That is where the discounted payback period comes in. Instead of just adding cash flow, we discount them to reflect their actual value after the time. So this method gives a more realistic picture of when an investment truly break even. It's just like checking how much your money really earned after considering inflation and interest rate into consideration. So what we have learned till now, that payback period method is simple and quick. It is great for a small investment. Risk and productivity, that means shorter. So discounted payback period we are talking about. So payback period is simple and quick. It is great for a small business. Risk and profitability. Shorter payback period means lower risk and quicker return. But it ignore cash flow after the payback period, meaning out on the long term profitability. So there are disadvantages also, right? So we talked about the profit advantage is that the advantage is that it is simple, it is quick, right? It is quick, but there are some limit. You can see it is simple concept, right? Risk and profitability, shorter. If the payback period is shorter, it means risk lower and return is quick. And limitation is that it ignores the cash flow after the payback period, missing on the long term profitability. That is why big business use more advanced method like NPV and IRR for better decision making instead of this payback period method. So if you want to know how soon your investment pay off, the payback period method is used. But for a smarter approach, consider the discounted period method, discounted payback period, which is very, very important, right? So let me illustrate it using an example which is provided in your book. The same example I am providing you. You can see it here. So suppose a project cost. So imagine you are investing 20 lakh in a business, and every year you earn a profit of 3 lakh after accounting for depreciation. But wait, we still need to pay tax, right? So let's calculate the actual cash inflow step by step. So we have profit before tax. You have invested to 20 lakh. You have profit of 3 lakh after 10% depreciation, straight line method, and before tax. So we need to pay 50% tax, right? So profit before tax, which is called PBT. PBT is how much? 3 lakh. Tax is how much? 50%. What is 50% of PBT? This is 1.5 lakh. So what is PAT? Profit after tax is 1.5 lakh. So after paying tax, we are left with 1.5 lakh, right? But that is not all. Depreciation is a non-cash expense, You know about this? This depreciation is a non-cash expense. It is expense, it is a type of expense, but it is not in the cash form, right? So that we will add earlier. Since it does not involve the actual outflow of money, we can add it back to our cash inflow, right? I told you earlier that depreciation is a non-cash expense that we added earlier. So since it does not involve an actual outflow of money, money does not goes out, right? So we add it back to our cash inflow. So you add it, right? So you add 1.5 plus 2 lakh, which is depreciation, because 10% of this 20 lakh is 2 lakh, which is depreciation. You will get 3.5 lakh. Now that our business generate 3.5 lakh of cash every year, let's find out how long will it take to recover our 20 lakh investment, right? So the formula is quite simple. First of all, you have to calculate the how much is the total cash inflow per year, and you know that 20 lakh is the total cost. You divide 20 lakh with 3.5 lakh, it will give you 5.7 year, which means 5 year and 8.5 month. So what is the key takeaway? It is simple and effective, right? Lower payback means lower risk, but it has limitation that it ignores profit after the payback period, right? Now let's take another example. Let's take another example for ABC Limited to calculate the payback period. Imagine you are the financial manager of this ABC Limited and your company is considering investing rupees 2 lakh in a new project. But before you approve it, you will want to know one key thing: how long will it take to recover the investment, right? So that is where payback period comes into picture. Let's break it down step by step. First of all, you have to understand the cash inflow. Every year this project will generate some cash inflow, and here is how much ABC expect to earn. First year this much, second year this much, third year this much, and fourth year this much. So this is the expected return. In the previous year, in the previous question, what was happening? You invested some amount, right, and you earn a profit of how much? 3 lakh. That was written after accounting for depreciation, right? So that was the case. We are just talking about 1 year, but here we have all the 4 year cash inflow are different. So it may be possible that cash inflow are different for all the 4 year. You can see it clearly written here. So every year this project will generate some cash inflow, and how much cash it is written here. Now let's take how quickly we recover this 2 lakh rupees. So what you do in this case, you will do cumulative cash inflow. I told you now that sometimes what happens that profit are not equal. Like in this case, you see the cash inflow are not equal. In the previous case, cash inflow were equal. That's why we quickly divided it by the profit. We get the answer. But in this case, it is not like so. So cash inflow are variable, right? So what we will do? We will find cumulative cash inflow. How to do that? You write 1 year here, you prepare a column for year, you prepare a column for annual cash inflow, and you prepare cumulative cash inflow. Just write this 8 to 8. You add these two, you will get this. You will add these two, you will get this. You will add these two, you will get this. So what we see, at the end of 3 year, ABC Limited has recovered its entire 2 lakh payment. That means payback period is 3 year. Right. So now let's revise it. Now let's say the investment increased slightly to 2 lakh 5,000. So initially investment was 2 lakh. Now let's say investment increased to 2 lakh 5,000. What happened to the payback period? So after 3 year, what is happening? After 3 year, 2 lakh is recovered, right? The year 4 cash inflow is how much? What is the year 4 cash inflow? Year 4 cash inflow is how much? 2 lakh 20,000. Since we only need 5,000 more, so we take a small portion of the year 4 inflow to complete the recovery. So tell me, part of year 4 used, part of year, so this is our investment now. Earlier it was 2 lakh, now it is 2 lakh 5,000. So now tell me, part of year 4 investment, how much it is? It is nothing but 5,000, which is our extra investment, and upon 20,000, which is nothing but 1/4, which is nothing but 3 months. So now the payback period will be 3.25 year, which means 3 year and 3 months. So what we learned from this discussion is that payback period means time needed to recover investment. Shorter payback means lower risk, quicker return. So but the limitation is that it ignores cash inflow beyond the payback period.